The new year began with a new season of Shark Tank India.
Excited about the new season?
Of course. अगर ये धंधा सच में multi-billion dollars का है, तो आप छोड़ छाड़ के बैठ क्यों नहीं जाते?
But this time, the real sharks were the ones on social media, going after the venture founded by one of the sharks of the previous season. Yes, I am talking about Ghazal Alag and Mamaearth, the company that she founded with her husband Varun Alag.
ना कोई बिजनेस डिग्री, ना सिल्वर स्पून, कुछ था तो सिर्फ माँ होने का एक्सपीरियंस.
Mamaearth is a direct-to-consumer brand that started by selling baby care products. It has, in the past few years, diversified to a whole range of stuff from skincare to hairstyling. Mamaearth's IPO plans ran into rough weather soon after the company filed its draft prospectus in the last week of December. Why? Well, valuations. While the draft prospectus made no mention of valuations, the market participants latched on to an investor expectation of $3 billion or 24,000 crore rupees and found it way too high. Right from tweets pointing out the weaknesses in the company's financials, to the valuation sought being unrealistic, to memes about Ghazal Alag's statements made on the Shark Tank shows, investors on Twitter have been bashing up the company. And this is something which is unprecedented. None of the earlier unicorns, such as Paytm, Zomato, and Nykaa, suffered so badly on their filing of the initial IPO documents. So what's so wrong with Mamaearth IPO? Is it just valuations or timing or something more?
This is almost a 20 times price to sale and a 1,700, 1,800 times price to earnings. It just created a massive backlash for them.
I'm not sure where the 3 billion number came from, to be honest. I'd say its valuation is ballpark around 1 to 2 billion.
So why is Mamaearth planning to list now, especially when the market sentiment has turned negative for unicorns? Are the exiting investors seeking the peak of direct-to-consumer or D2C businesses? For that matter, is Mamaearth really a D2C business? What is the likelihood that Mamaearth IPO will not go down the same road as other unicorns before it? And will the Mamaearth IPO be the end of the D2C fairy tale for the FMCG industry that is busy acquiring small digital startups? All this and much more in today's episode of The Morning Brief. It is Tuesday, January 10th, and I'm your host, Kiran Somvanshi, exploring the prospects for Mamaearth's IPO, especially after all the backlash. Its possible fair valuations, and can it really manage to be the unicorn IPO making money on the street? Mamaearth is a flagship brand of the D2C company Honasa Consumer. Now, Honasa was incorporated in 2016 to provide toxin-free, natural personal care products, especially for babies. Now, according to the company's prospectus, it is the largest digital-first beauty and personal care company in India. But the company's financials raise several questions. To address those, we have venture capitalist Aviral Bhatnagar of Venture Highway, contra investor Lalit Rathi of LKR Advisors, and chartered accountant Mehul Shah, partner at Rashesh, Shah & Company, sharing their insights. All three of them have expressed their views on the Mamaearth IPO on social media. So the first obvious question is, what irked the retail investors so much about Mamaearth's IPO? Were the investors really tired of the performance or the underperformance of the earlier tech IPOs and took it out on Mamaearth? Or, are there genuine concerns about the company's performance?
Let us first appreciate what the company has achieved till date. It was a 14 crore turnover company, now going to hit 1,400 crores in FY23 in just 5 years. Market share of 5.5%, 18,000 pin codes per se, made a 3-4 acquisition in a very short span of time and catering to close to about 6 million active monthly users, right? But a great business and good promoter does not actually mean a good valued stock. So the issue came in limelight last week when the company filed its DRHP, where it said that, hey, 400 crores of primary infusion we are going to do, and close to about 4.68 CR of secondary OFS shares, which has been sold, which is expectedly valued at 2,000 crores on mark, right? Now, the so-called sources in the market in June 2022 mentioned that they are looking at a IPO at a valuation of close to about $3 billion, which is how the figure of 24,000 came into picture. For a company which did FY22 revenue of 943 crores and a 14 crores PAT rate, this is almost a 20 times price to sale and a 1,800 times price to earnings. It just created a massive backlash for them. Let's also not forget that just a year back, Sequoia infused $52 million, took about 24% stake at $1 billion valuation. Now, what changed in the last 12 months that the company moved from a valuation of 1 billion to almost an expected value of 3 billion? And that's the reason it was made such a big issue in terms of, the entire IPO coming in.
That was contra investor Lalit Rathi. However, Aviral Bhatnagar, an angel investor, has a slightly different take on it.
I feel like there is a lot of anger and frustration with the way startup IPOs or tech IPOs have performed over the last year. And Mamaearth kind of became the lightning rod for that frustration in some sense, especially because there was no real valuation that was disclosed, but there was some number that people caught onto and then they just went with it. What I'm seeing is that, there are a lot of people who invested in these tech IPOs like Paytm, Nykaa, Zomato over the last year. When they got an opportunity to take it out, they took it out on Mamaearth. That's the underlying feeling. Just go back 2-3 months, just search for Mamaearth and look for the November articles on Mamaearth. They're all singing praises. The same guys were like, oh, this company is crazy and what are they pricing this company at? I've just been reading articles just like 2 months ago, not even a year ago, which are saying that Mamaearth is like amazing. When they reported their revenue, they're like, wow, this is fantastic. And now this thing has suddenly turned. Nobody becomes horrible in 2 months, right? It's impossible, especially for a company of this scale. So I think it's a perception thing that's largely driven with the price, which was not even supposed to be a topic of discussion in the first place. I'm not sure where the 3 billion number came from, to be honest. I think they were valued at $1.5 billion in their last round. Like generally, consumer brands trade at multiples depending on their gross margin. But I'd say like a 5 to 7x is what people say is fair. I'd say its valuation is ballpark around 1 to 2 billion. The fact that they have not mentioned a valuation in the prospectus and a number was allowed to get out, I think it should have been managed better. I don't know how retail investors will react to this whole negative sentiment as well as other institutional buyers, because now suddenly everyone is thinking that, oh, this company is overpriced, and that sentiment matters.
The overall sentiment for startups has turned negative for sure. With the funding winter having set in, the underperformance of already listed unicorns, and the overall uncertainty in the global financial markets. Several unicorns such as Boat, Snapdeal, and Farmeasy have deferred their plans to list. So the obvious question is, what are the pulls and pressures that made Mamaearth decide to go ahead with their IPO plans? And are they getting bashed for bad timing?
This has a very important connection in terms of how much the private equity folks can continue to infuse in the company, right? What you are seeing in US is a very tightening of liquidity situation. The so-called easy money is no more available. And hence the only other opportunity for them to exit out is via the IPO. Either they have to keep pumping in, keep sustaining it, or close the business, or have to commit with an IPO. So you can call it as a really, really bad timing for them. And let's not forget that there are about 60 to 70 startups who have raised Series D and Series E funding in last 24 months. They have to also hit the markets, and hence they'll be forced to come up with IPO every now and then. And people have burned their money big time. It's not a matter of 500,000 crores which they have burnt, right? The likes of Paytm, Zomato, Nykaa, Delivery, Car Trade, combined Policy Bazaar, combined investors have lost close to about 1.5 lakh crore of their hard-earned money, which has gone down the sink. And despite the stocks correcting 50-60%, you're still valued at price to sales of 10-12 times, which shows that more fall and more downfall is still pending. So it's going to be a very long, grinding, painful journey. And you can call it as a bad timing. With private equity, have absolutely no other option to pump in across and push it off to the retail.
So, who are the exiting shareholders in the Mamaearth IPO? Among those diluting their stake are celebrity Shilpa Shetty Kundra, Snapdeal founders Kunal Bahel and Rohit Bansal, Marico's Rishabh Mariwala, and multiple institutional investors such as Sofina, Stellaris, Fireside Ventures, and Evolvence. Aviral thinks it is a decision of the founders when to list. But he does provide a bull and bear case for Mamaearth.
I think the bull case is that it's a really fast growing company. In fact, if you look at its financials, they 4x'd the year before this and they've 2x'd last year, FY22. And I think if they complete on track at least of what numbers they've reported, they're going from 400 crores to 900 crores to 1500 crores, which is pretty good. They've doubled a year and they've gone up by like 60%. So the growth rate is pretty good. I think they have a strong margin profile as well, at least as the data that I saw in the prospectus was their gross margin is like 60%, 70%, which is good. Now, the bear case is that they stagnate and they do nothing. This is their max. They get stuck, which happens with a lot of companies, by the way. But again, these are things that you have to look at when you're investing, right? It's a company one should deeply research and see if there is some upside, because I think there are a lot of things going well for the company overall.
So Mamaearth will be the first D2C unicorn to get listed. But hold on. Is Mamaearth indeed a D2C company? And if so, I wonder how long will it remain that? Because the company's sales from online channels as a proportion of its total revenues has been steadily coming down. Right from 91% in financial year 2020 to 59% for the first half of the current financial year. And of course, expanding online doesn't come cheap. Mamaearth operates 35 of its own exclusive brand outlets and sells its products through a network of 440 distributors and stockists. And all this has led to increased cash outflows on all things like working capital, larger workforce, and of course, channel marketing.
Mamaearth cannot be solely treated as a D2C startup. Of course, D2C startups commands a higher valuation as compared to e-commerce startups or as compared to a startup who has a offline channel of distribution. But if you look at Mamaearth, 60% of its sales comes from third-party e-commerce website like Amazon, Flipkart, Nykaa. So it cannot be considered as a pure D2C startup. Even if I look at the red herring prospectus, it has around 141 crores of debtors, trade receivables, which is almost 1/12 of the estimated sales of the year. So that also shows that it cannot be treated as a pure D2C startup. So something you can see is between a combination of D2C plus an e-commerce operator at the same time, plus products who have an offline distribution channel like HUL or Marico.
That was chartered accountant Mehul Shah from Surat, who also supports and advises startups. Lalit also shares a similar view, but with a different explanation.
Mamaearth per se does not have any own setup manufacturing kind of a place, right? So they are just a market player, you can say. They all have as a brand, and that brand has been getting sold. Their average product pricing is from the range of 200, 800 rupees kind of stuff, right? Their competitors might be someone like a Sugar Cosmetics or a Purple or a Himalaya. Mamaearth themselves in their DHRP have not given anyone in this space of Nykaa kind of stuff, right, as a competitor at all. And I was pretty surprised to see they had compared themselves with the like of HUL, Colgate, Dabur, Marico, Bajaj Consumer, Gillette kind of players, right? Today you go to a store and ask them about Mamaearth's, working capital cycle, they'll say that, hey, look, we have got a credit for 3 to 4 months with a return policy. I can return my products if it goes unsold, right? So there's a huge risk and a huge difference between all of these players with whom we are speaking, vis-a-vis Mamaearth. Mamaearth is nowhere. In fact, if you remember, there was in season 2, episode 1 of Shark Tank, there was a player who came up, I think the company name was Recode. It was rejected in Shark Tank because it was a competitor of Try Sugar, which was coming across. Mind you, the company was doing a turnover of 30 crores, profitable 7% margins. To me, he's a real competitor for any of these players. There are about 3,000, 3,500 BPCs in India, beauty personal care segment. 500 of them having a revenue of more than 20 CR. 35 to 50 of them are having revenue of more than 100 CR. So there are a lot of them in the segment who are there both on online space and on offline. Hence, to me, they don't fit in anywhere. They are neither an FMCG, they are neither a like of Nykaa, which is a top of the brand recallability factor, nor they fit in this unorganized segment at all.
So, if and when Mamaearth finally gets listed, it'll be interesting to see what it will be compared with. Will it be Nykaa or HUL or any other FMCG company? And this comparison is important for the market to decide the company's fair valuations. Interestingly, Mamaearth's prospectus describes the company to be a unique one with no listed peers. Mehul sheds light on whether Mamaearth should be pitched against Nykaa or giants such as HUL and other FMCG companies.
So, Kiran, if you look at the last valuation, the round was led by Sequoia Capital, where they invested around $52 million at a valuation of 1.2 billion. If I convert this into rupees, it comes to 8,000 crore pre-money valuation. Again, if I compare it to Nykaa, let's say, for example, then I would say let us look at the current market capitalization rather than the IPO price of Nykaa. And the current market capitalization is around 40,000 crore. I would say the profitability of Nykaa, they have shown a profit of around 41 crores, which is again around 4 times the profitability of Honasa. So if I discount the market capitalization of Nykaa of 40,000 crore to 4, the valuation comes to around 10,000 crore, which will again give a fair upside to the last investor who has entered at 8,000 crores. So I feel even on a higher end, considering the growth, considering keeping a bet on the founders, and particularly one good factor is it has done some good acquisitions. So it is not only Mama, but they also house some other 5 brands like Derma Company, Ayuga, Dr. Sheth, Be Blunt. So considering all those factors, I feel 10,000 even on a upside would be a higher valuation, which would also justify the round at which the last investors have got in. So if you compare Mamaearth with other FMCG companies, HUL has a PE of 62x, Godrej Consumer has 57x, Marico has 53x, Imami has 23x. So even if you look at the overall Nifty index of all the skincare products particularly, the PE comes to around 59x. As compared to this, the last investor led by Sequoia Capital, they've invested in Mamaearth at 329x of PET.
Which is quite high. Lalit also provides a conservative estimate of the fair valuation that Mamaearth could command.
For a startup loss-making entity in a present scenario, given a choice, there's no valuation at all. In the first half of this year, they did a PAT of 3 CR, right? But they have a negative operating cash flow of 65 CR during this same period, which means nothing but there's a sharp jump in inventory and trade receivables, which is there. So obviously, I can't apply a method of price to earnings in this case. Now comes your second method of sum of the parts valuation, where you value each of the brand they have, combine the entire value, and then try to identify. It's a slightly complicated because many of their brands are at a very nascent, high burn kind of business. So typically now the third way of valuing this particular business is the price to revenue kind of multiple. Now, what is the right price to multiple revenue which can be given? You have players which are in a highly organized market at a price to multiple of 7 times to 10 times, right? Whereas Mamaearth in the present valuation, which has been expected or expecting a price to multiple of 17, 18 times. So to me, personally, I would say a price to multiple of 4 to 5 times. That itself is quite high. For example, see, this year they're going to do 1,400 crores of revenue. 5 times is nothing but 7,000 crores of valuation. Assuming a 1,400 crores revenue, a 5% PAT has been done, right? Which is 70 crores of PAT, which is nothing but you're already valuing the entity at 100 times price to earnings, which is huge, right? So to me, it just does not make sense even to value them at 4 to 5 times price to one. But I think, Kiran, they would come up in the range after all the backlash they have faced at a value of probably 1.6 to 1.8 billion dollars. That is what I personally feel they'll end up.
So in rupee terms, it will be in the range of 13,000 to 15,000 crore rupees. So while Mamaearth's business model is similar to a FMCG company rather than a marketplace like Nykaa, its financials and business model are still quite different from a pure play FMCG business. As I was recording this podcast, my 9-year-old kid came up to me and asked, "Why are you talking about the Mamaearth cream?" I realized the company has fairly succeeded in gaining visibility. But the question to me was, at what cost? While FMCG companies typically spend 8 to 10% of the revenues on advertising, Mamaearth spends nearly 40% on pushing its brands. Now, the company had spent 391 crore rupees on branding and promotion in the financial year that went by. And in fact, it is the same as the amount of fresh proceeds that the company is looking at raising through its IPO. Mehul analyzes this further.
If you look at the numbers, the total ad spend in 2021 was 178 crores and the sales achieved was 460 crores. Comparatively, the total ad spend in 2022 was 391 crores and the total sales was 932 crores. If we calculate the return on ad spend, that is the ROAS, which is a good number to monitor, it ranges between 2.4 to 2.6. Now, what is more astonishing is, even if I look at the last 4 years, the ROAS has always been in this range of 2.4 to 2.6. It has never increased. Once I increase the ROS, it shows that my organic sales has increased. It is a sign that I have some repeat customers. But as the ROAS in case of Mamaearth has not increased, it shows that there are fewer repeat customers, there are fewer organic sales. If we compare the same ROS of Mamaearth with Nykaa and HUL, the ROS of Nykaa is 7.8 and the ROS of HUL is 10.6. So this shows that still the growth of this startup is very much dependent on the ad spend and the result of the ad spend. So even if the retail investor assume that the valuation is going to be derived from the future revenue and the future profitability, it is still a tough task because at present still there has not been a good correlation between the ad spend and the revenue, which shows that still we need to burn cash to achieve those revenue.
That's quite a disincentive for investors, right? But Aviral advocates being patient with startups spending on advertising to achieve their growth.
I think because startups scale so fast, we forget that we need to be patient with them as companies too. One of the big reasons why the losses have decreased so drastically for Mamaearth is because they've ramped down these expenses that you're talking about, right? Otherwise, their losses would be extremely high, and then this conversation would be about what a crazy loss-making company it is, and it's still asking for such a valuation. So my sense is that, especially in like consumer brands which are not as tech-led, they take time to improve their margin profile. There's a lot of optimization that needs to be done. And you're absolutely right that advertise something like this is not sustainable. Why it is done is because they need to show
That they exist.
and they're trustworthy, right? So how do I create a brand in 6 years when there's a brand that's competing with me that's there for 70 years? I have to accelerate that relationship with my customer in that short time period. And the only way I can do that is advertise and be there everywhere so that people start thinking that this is real.
Correct. But does that mean that when you actually stop doing that, what you initially did in terms of advertising, then it will also again take you back?
That is an absolute risk. Will that mean that their growth will be much lower than what it is, right? The whole startup story is figuring out a business model, right? We all invest in a hypothesis. Now, the question is that have they figured out a business model that will be profitable and will grow? Or have they reached the end where they've spent so much and now with this new model where they have to spend much lesser, they'll grow very slowly or remain flat, right? That's a risk that you are betting on, the business model risk or execution risk, whatever you want to call, when you're buying the stock at whatever price it lists.
So, advertising one's way to growth may be a calculated risk for a startup. But what about diversification into products, services, and even content platforms? For a 6-year-old company, Mamaearth has fired on quite many cylinders. It has a range of personal products from Ayurvedic ones to organic to science-based ones. But it has also jumped into the grooming business through the acquisition of B Blunt chain of salons from Godrej Consumer Products. At a time when most FMCG companies are buying D2C startups, here is a D2C startup that bought a service business from a leading FMCG company that is itself investing in setting up its own DTC platform. And it gets more interesting here. Mamaearth also owns a women-centric content platform under the acquired company Mompresso that talks on everything from childcare to parenting. And hold on, it even talks about money and investments. So it's not just Mama knows it all, it also is looking like Mama owns it all. Lalit believes that diversification is a necessary evil for such a growing startup.
You have no other option in a respective TAM market, which is your target addressable market. And if that is getting squeezed every year, they grow at 300%, they grow at 100% last year. This year, their growth is only 50%, right? This company per se has one own brand, which was Mamaearth, which was started as more kind of a baby product segment.
Right.
Their baby care segment just now contributes only 20% of the revenue, which is nothing but 80% of the revenue is coming from the so-called hair and skin care segment, right? Let's not forget that all their other brands which were there were acquired. And that acquisition was because you need to grow. And the growth can come either internally, which is going to take a lot of time, or you acquire a well-established kind of a brand and quickly grow. So it's a combination of a theory which they themselves are trying to do. They were all over the place. So I think they were going to burn way much quickly. Even in this IPO 400 CR, they have given 185 CR in advertisement, 30 CR for B Blunt, another 30 CR for expansion of exclusive brand outlets. So the remaining 150 CR has been left for kind of acquisition, right? I mean, that's the only amount which has been left, which has not given any explanation at all. I think they will go ahead and acquire one or two more brands, try to see expand the revenue across. That's the only way for them to do it.
I wonder if Mamaearth's IPO will be a reality check for several large FMCG companies, including HUL, ITC, Marico, and Colgate Palmolive, that have jumped on the bandwagon of buying into D2C startups.
Every single now and then you will have, startup DTC companies here to list themselves. Of course, we had the like of, HUL, which acquired in a plant-based startup supplement brand called Ziva.
Yeah.
But those were pretty small in terms of revenues. ITC acquired Mother Spash, which was again a pretty small, a 5x, 7x kind of multiple. So you have smaller player which will keep getting acquired by larger guys. Such kind of players, they can acquire a 250, 300 crore kind of, and try their online space for. They have absolutely nothing to lose per se. Once you cross the particular threshold where you can't be acquired by the other player, the only way is going and getting yourself a private equity guy who is ready to pump in 500, 700 CR, or going and getting yourself listed. In this particular case, they had a hard choice of getting listed, and it's not going to last for long. I remember late Rakesh and all are saying this very clearly. In the startups eco space, they want to do everything and anything which is working for them, because the investor expectation is get me growth at whatever value and cost. I've been an investment banker for almost a decade. I have seen more than 1,000 plus deals. And I have personally felt that the entire ecosystem is screwed up big time, because the next round of guy who is investing in you, all is asking you is for the valuation.
Correct.
It's only in the last, probably 12 months where people have started, or these startups have started speaking about profitability or the cash flows. Well, it's just been valuation. I think Indians celebrate a lot when they get their funding. I always keep saying, hey, celebrate when you give an exit.
Mehul regards a much abused valuation method to be the reason behind the overvaluations of the D2C startups.
I would say the use of revenue multiple as a valuation method has actually contributed to the overvaluation of the D2C startups. I would not say about Mamaearth, but D2C startup in general. Let's say a startup X comes to me and seeks 1 crore rupees when he's having a monthly sale of 10 lakh rupees, and say, I, as an early investor, say yes to invest into that startup at a valuation of 10 crore.
Okay.
Now the question is, have I valued as an investor the startup solely based on sales? Then the answer is no. I have seen the conviction in the founder and his efforts or his background, like how many stings he has done in the past in the same industry. The founder may have promised me that using my 100 crore, he has shown me a growth that he would reach a sales of 50 lakhs.
Right.
And on that basis, I have made a valuation of 10 crore. But when I made this investment, the news goes into the market that Mehul Shah, as an angel investor, has invested into a D2C startup at 10 crore valuation when the sales were just 10 lakh rupees. So it gives a multiple of 100 on the MRR.
Right.
The other startups use this multiple to make their own valuation.
And that slowly results in a valuation bubble. But if Mamaearth values itself fairly, does it have a chance to be an exception to the trend of tech IPOs that have lost investors' wealth? Lalit doesn't think so.
Absolutely not. Not at all, Kiran. I don't think there'll be any sheen of disappointment because they can't value themselves lower than 1.2 billion, which was the last valuation done by Sequoia. And let's not forget, by the way, Sequoia is not participating in this particular round at all, which is nothing but they are holding 24% stake, not participating in this particular OFS issue. So once they are going to list their IPO, because Sequoia at some point of time in the next 12, 18 months or whenever they get an opportunity, right, would like to exit.
Right.
If not for a full exit rate, partially 3-4%, 3-4%, 3-4%, they have to dump to the market. And once they start dumping such a kind of quantity in volume with absolutely no buyer, retail is not at all interested. Qualified institutional buyers have completely lost their money in the previous issues. So the only guys is the mutual fund, and mutual funds are not going to come across because there's a lot of backlash already, and people are saying that whichever mutual fund is going to apply, they're just going to redeem the scheme. So there's no one left. So when you're going to start selling that kind of a stake in market every now and then, you know what the interest is going to look like, right? I mean, it's a sinking boat, hard way, hard call, but yeah, no other option. Frankly, I'll really not be taken aback if they pull out of this IPO because there's a lot of backlash which they have faced. In fact, it's good. They've got some feedback, by the way, because after setting the price, you don't get an opportunity for feedback. Or here, even before determining the price, they've got this feedback very clearly, right? Saying that, hey, market is just not going to like you.
Yeah.
You still have some more time before you hit the market. And there are many, many more IPOs which are lined up in 2023, which I think are going to be stalled until unless the US liquidity is going to pump in across. And, we are going to see one more new round of startup ecosystem valuation or new round of inflows, which is going to happen. Unless that is going to happen, all of these guys, either they're going to shut down because private equity guys won't be able to support. They'll have to allow them to die. We're already seeing a lot of startups who have fired their employees. Employees used to love startups. We saw a lot of MBA guys, all the IIT IIMs were flooding startups just 18 months back, Kiran, right? If you remember, during the Cricket World Cup, they used to give this free World Cup ticket, a Kawasaki bike for product development managers who joined that startup. All of those is gone, completely gone, right? And many of those startups who gave those have also shut down, by the way, just in a matter of 12 months. Many of these founders have not even seen one cycle of startup ecosystem. So one cycle of 8 years, once they see, I think they'll be much, much more successful. In my view, it's way too early for Indian ecosystem. It's not as much matured as the US ecosystem is. I think there's going to be a lot of pain.
In such a scenario, it becomes all the more important for Mamaearth to get its IPO right and to create value for its retail investors. Both Mehul and Aviral have put forth arguments about why Mamaearth has a reason to not repeat the mistakes made by the startups listed before it.
So I would say, first of all, the founders come from a background where they have taken Shark Tank to every household name. And in Shark Tank, the sharks have taught the investors how to look at valuation, what right questions to be asked. And now the same founder is on the receptive side. So it is the role of the founder to ensure that retail investors also make money out of the capital appreciation or the dividend which is to be declared in this company in future once they go listed. Another reason I feel that why this IPO should not fail is also because people have looked to other IPOs like Paytm, Nykaa when they come to be a super successful company on an asset-light model. Those companies have changed the ideology of the people that it is not only the net asset in the balance sheet which is to be looked upon, but also the off-balance sheet item like brands, the intangibles, the trademark. So वो अगर चौथी बार ऐसा हुआ या तो that conviction might fail. And the third reason is because these are investors who have been investing in the stock market, and these investors are also now becoming angel investors. Last 2 years, we have seen a lot of stock market investors who have, parked say 10% or 20% of their portfolio money into startups. So if the retail investors would keep on doing loss into IPO, that conviction of converting these retail investors into angel investors would fail.
A lot of founders who are, in the middle stages, which is like they're not seed, but they're not going public anytime soon. They've got quite frightened with all of this. Anyway, the founder journey is so hard. You don't want them to be scared of going public, right? Because they're like, oh my God, what is this backlash? I don't want to deal with this. And it's fair, right? I mean, I'm sure both Varun and Ghazal have had to personally speak to so many people after whatever has happened. I hope they will take in all the feedback, and this could be a blessing in disguise where they got the answer without even disclosing the price. If startup IPOs tend to continue to perform badly, I think retail will lose faith in the asset class, and then you lose a very important way to exit,
Right.
both as a founder and as an investor. And I don't think the ecosystem wants that. So I don't think anyone's incentives are aligned to destroy anybody's wealth, is my sense.
We reached out to the founders of Mamaearth for this episode. We shall update this podcast as and when we get the response. Though unprecedented, the backlash for Mamaearth's valuation was important in many ways. It sent a strong message to the startup ecosystem, right from the founders to venture capitalists to private equity players and to investment bankers. The market is in no mood to digest one more bad case of dumping an irrationally priced startup onto the retail investors. The ball is now in the court of Mamaearth's shareholders. They have to decide whether to postpone the IPO for want of better market sentiment or roll it out at fair valuations, leaving money on the table for the retail investors. A profitable exit for existing investors doesn't have to be value destroying for the public investors. All the previous unicorn IPOs have destroyed investors' wealth, making it very important for Mamaearth to not go down the same road. The company has an opportunity to help restore the faith of retail investors in the whole startup growth story and set the right precedent for future startups. How can it do so? The company can correct its valuation expectation, and its exiting investors can limit their greed a little. Leveraging on easy money was easy and possible till last year. But now, aspects like getting the unit economics right, reducing customer acquisition cost, getting repeat customers, finding one's niche, addressing a genuine pain point, and being able to withstand the pressure of investors' expectation are critical before startups can even think of listing on the stock market. As for Mamaearth, it is now upon its founders to take the backlash in their stride and make the company yet another startup whose IPO failed, or make it the first unicorn IPO that made money for the street. A big thank you to our guests Aviral Bhatnagar, Lalit, Rathi, and Mehul Shah for sharing their amazing insights. And thank you for tuning in to this podcast brought to you by the Team Economic Times. Show producer Vinay Joshi, sound designer Rajas Naik, executive producers Anupriya Bahadur, Anirban Chaudhary, and Arijit Barman. We hope you like this episode. Do share it on your social media networks. The Morning Brief drops every Tuesday, Thursday, and Friday. The Morning Brief is now streaming on Amazon Prime Music and JioSaavn, apart from Spotify, Apple, and Google Podcasts. And of course, ET's own audio platform, ET Play. Do tune in to ET Play, our latest platform for all audio content. Have a great week ahead. All clips used in the episode belong to the respective owners, credits mentioned in the description.